With the markets closed for the weekend, Tilray Brands Incorporated, trading under the ticker TLRY, finished Friday's session on September 26, 2025, at a price of $1.15, marking a decline of 3.36% for the day. Now, the immediate reaction for many watching this stock is to lump it into the general malaise of the broader cannabis sector, a space notorious for volatility, regulatory headaches, and promises that always seem just one legislative vote away. The expectation is a simple story: a stock beaten down, waiting for the U.S. to finally reschedule or legalize cannabis. But that narrative, while not entirely wrong, is dangerously incomplete. The reality of Tilray today is far more complex and hinges less on the singular event of U.S. legalization and more on a multifaceted and, frankly, precarious global strategy that is unfolding right now. The company is no longer just a cannabis producer. It's a sprawling consumer packaged goods entity with deep investments in craft beer and spirits, a significant medical cannabis footprint in Europe, and a strategy that is attempting to build a moat before the floodgates of full U.S. legalization even open. This isn't just about waiting for a political catalyst. It's about whether Tilray can execute on a global scale in multiple, highly competitive industries simultaneously, all while managing a balance sheet that has seen its share of strain. The common belief, the one you'll hear discussed on forums and in basic market commentary, is that holding Tilray stock is a straightforward bet on the future of cannabis. You buy it, maybe through a platform like Robinhood or SoFi Invest, tuck it into your individual brokerage account, and wait for the inevitable legislative dominoes to fall. This perspective views Tilray as a high-beta proxy for the entire industry. When positive news about potential U.S. rescheduling hits the wires, TLRY stock tends to surge. When delays are announced or banking reform stalls, it pulls back. This expectation frames the investment as a patient waiting game. The reality, however, is that this waiting game is masking a far more active and aggressive corporate transformation. Tilray's management isn't just waiting. They are actively diversifying away from a pure-play cannabis model. Their acquisitions in the beverage alcohol space, bringing brands like Sweetwater Brewing, Montauk Brewing, and Breckenridge Distillery under their umbrella, are not just side projects. They are a core part of the strategy to build a distribution network and brand loyalty in the U.S. before they can legally sell cannabis products there. This is a backdoor entry, a way to establish a presence and infrastructure that can be pivoted once federal laws change. So while many investors are watching Washington, D.C., the more critical developments might be happening in the financials of Tilray's beverage division and its ability to gain market share against established giants. This is a far more challenging and nuanced operational reality than simply waiting for a law to pass. Looking at the recent market action, the stock's behavior tells a story of this very tension. The trading volume on Friday was over 43 million shares, a significant figure that speaks to the high level of interest and speculation surrounding the name. In recent months, we've seen incredible surges in the stock, with a nearly 200% climb at one point, largely fueled by renewed optimism around the U.S. Drug Enforcement Administration's review of cannabis classification. This is the expectation narrative playing out in real time. Traders on platforms like Interactive Brokers and Fidelity are piling in, trying to front-run the news. Yet the subsequent pullbacks, like the ones seen last week, reflect the reality setting in. Investors digest the fact that rescheduling to Schedule III is not full legalization. It would ease research restrictions and potentially offer tax benefits by removing the 280E burden, but it doesn't open the door for recreational sales across state lines, nor allow these companies to uplift to major exchanges without caveats. The market is constantly oscillating between the dream and the difficult details. Institutional ownership provides another layer of this complex reality. While the overall institutional ownership is relatively low, recent filings show a fascinating mix of activity. Some major players like Goldman Sachs have been reducing their positions, signaling caution. Conversely, firms like Citadel Advisors and Luxor Capital Group have been significantly adding to their stakes. This isn't a monolithic vote of confidence or no confidence. It's a sign of a deep strategic debate among the so-called smart money about Tilray's future. Some see a speculative asset with regulatory hurdles, while others see a diversified consumer goods company trading at a deep discount. To fully grasp the scope of this operation, one has to understand what Tilray Brands has become. It's a Canadian company at its core, one of the largest cannabis producers in the world by revenue. But its identity is now split into several key verticals. First, there's the Canadian cannabis market, both medical and recreational. This market, which once was the great hope, has been plagued by oversupply, intense price competition, and a burdensome excise tax structure, making profitability elusive for almost every player. Then there is the international medical cannabis segment, which is arguably one of Tilray's brightest spots. The company has a significant head start in Europe, particularly in Germany. With its EU GMP-certified production facilities in Portugal and Germany, Tilray is well positioned to capitalize on the descheduling of medical cannabis in Germany, which is expected to dramatically expand the patient and prescription market. The recent acquisition of a new cultivation license in Germany is a tangible step forward, allowing for a five-fold increase in production capacity and the introduction of new genetic strains. This isn't speculative. This is real, operational progress in a market that could become one of the largest medical cannabis markets in the world. And finally, there is the U.S. strategy, comprised of the growing beverage alcohol portfolio and its wellness division, which includes hemp-based foods and CBD products. This is the placeholder, the brand-building machine intended to keep Tilray relevant in the American consumer's mind until cannabis is federally permissible. This three-pronged approach is ambitious and costly, a high-stakes balancing act that many investors, focused solely on the cannabis angle, often overlook. An investment in Tilray today isn't just an investment in cannabis, it's an investment in a global consumer brands company in the making with all the execution risk that entails. Many retail investors using online investing sites might not be fully aware of this complex operational web when they purchase shares. They are buying the cannabis story, but they are getting a beverage company and an international pharmaceutical-grade producer as well.